Welcome to Further Up and Further In's new webinar, Best Asset Classes of 2023, and which you think might be the best asset class in 2024. We have three awesome guests today, Ellis, Hammond, Bethany, Finch, and Ethan Moore. Can I ask you guys to just kind of go around in that order and introduce yourself and tell our audience a little bit about yourself and your business? And while they're doing that, you guys can start putting in the chat where you're hailing in from, LA, New York, wherever you guys are from. I'd really like to know. So Ellis, let's start with you.
Hey, everybody. Good evening. Yeah, my name is Ellis Hammond. My background over the last 4 years has been in the multifamily sector. So we've transacted on about 1,200 multifamily doors. Most of that's been a headache in the last 2023, so we can talk about that today. And then right now we're really focused actually in the land entitlement space and doing some cool things there and pivoting into where I see some opportunities. So excited about chat about all that.
Bethany?
Well, I'm Bethany Finch. I'm with American Made Home Solutions. We are 27 years in the real estate investing industry and focused mostly on multifamily through the years. Done a bunch of single family executive rentals as well, and moved into coaching as well as build to rent.
And Ethan?
Yeah, this is happy to be on here. So Ethan Moore from Southern Missouri, Branson, Missouri. It's a very unique tourism town. I was born and raised here, so this is my home. I love this place. But we started out with single family homes. Realized we did not want 30 of them like I thought I originally wanted. And so 5 years ago, got into self-storage facilities. And so we have 5 self-storage facilities where we own 100% of 2 and 90% of the other 3. It's been really, really good to us. I'm excited to talk about it tonight. So I love real estate. I love commercial real estate. I love investing. And we have a service company as well that we've done since 13 years ago. And so love entrepreneurship, love service companies. Yeah, excited to talk more about it.
Right, thank you. So the point of this webinar is really to examine the different asset classes in specific build to rent and self-storage and multifamily. So I know I've raised for a build to rent before, but I've never done a multifamily or self-storage. So I'm interested to hear what you guys have to say on those. So can you share a little bit with our audience about why you think your asset class is the best investment? Ethan, why don't we start with you?
Yeah. Man, this is gonna be good. All right, so I've got a lot of things to start talking with. I really like self-storage from an operational standpoint. I like being the operator. And it's very easy. I mean, if you can imagine, and I don't know how much you know, but it's management wise, it's extremely simple. It can be mostly automated. And so very easy on operations. I've never gotten a call or a complaint from the classic car that's stored in unit 107 saying that their music was too loud or that the lawnmower was banging around or something in unit 67. So I've never gotten those calls, which is nice, or that the toilet's broken. But from a management standpoint, it's really nice. People put their stuff in there, they forget about it for the most part, and then they keep it there. And it's difficult to move it out. People get comfortable with that space in there, so it's easy to keep our tenants in. So that'd be one of the big things I would say I would start with is from an operational standpoint. It's simple, and I like keeping my life very simple.
Don't we all? Ellis, why don't you go next? You're on mute, I think.
I just said I'm going to defer to Bethany because I'm not actually sure what she's talking about tonight. So I like to know what cards on the table. So I'm going to defer.
Know what you're up against, huh? All right. Go for it.
The only reason he's deferring is because he's unsure of himself. So when we think about asset classes, and Ethan, right there, right? He's got the answers. Why? Because he knows his asset class. He knows the value. He's come from one asset class, moved to another asset class. Tonight, I'm focused on build to rent. The reason I'm focused on build to rent is because what happened in 2020 had made a huge impact on the real estate market. And many folks who haven't been in the industry very long don't understand that. They don't necessarily play a long game, they play a short game. And a lot of the folks that got into multifamily during 2020 specifically, or 2018, 2019, right in there until now, got in at a unusual time for them. And so they built a lot of their businesses around that. So the nice part about build to rent is everybody always needs a place to live, but they don't always need a place to store their junk. I mean, at the end of the day, I agree. Ethan, no tenants, no toilets. I get it. I get it. I get it. But you also, that private collection of cars being stored in your units also have no soul. So no witnessing opportunities, no leading people to Jesus, no opportunity to impact
that's so
others and
true.
generational to come. So, on the one hand, yes, ours build to rent and multifamily is a bit more heavy on the operation side of it, but it's about people, man. It's about people. So if you're looking at it from the investment standpoint and legacy and what are we really doing here, it's like, I'm pretty sure we have a little bit bigger reach there.
That's really good. I wonder if she was going to pull that card on me. You know what? That's true. And I want to say this real quick because I'm glad you brought that up. This is kind of going a little bit off subject, but that's true. And I do think about that. What's also true is, because I was talking to my brother about this, kind of like, hey, let's build something. And what about the souls that Jesus cares for? If I didn't buy these self-storage facilities, who would? And would that person be kingdom-minded and stewardship-minded with that asset class and with those profits? The chances are they probably wouldn't. Chances are, if I didn't buy this, someone who would may not be kingdom-minded. They may not be a Christian. They may not steward it and look at these assets and the blessings that we have as something we can manage for the Lord. So yes, you're right. There's a huge opportunity when you're providing housing for people, but also I just wanted to throw that in there. Don't disregard something because you think you're not doing good. Because if you're not in business, if you don't buy the property, who will, and what are they going to do with it? And are they going to steward it as good as you can? That's how I think about it from a biblical standpoint.
Well parlayed.
Touche.
Mm-hmm. So Ellis, what do you got? Multifamily.
Bethany really went for the juggler, so I feel like she got her boxing gloves on tonight. So I'm just gonna come out and say that I think at some point all of the asset classes that have been talked about tonight have been good right now, to be honest with you. I think part of it is because the debt market is so volatile, and even if self-storage is so good, where cap rates are at in a self-storage deal, unless you're doing it like Ethan and you've been in the same local market for 10 years and you know all the sellers and you're buying stuff off market, you're not going to buy anything that has equity in the purchase price. So all of your value is going to be made in operations. So there's a lot of risk there that you better be a really good operator and know how to squeeze every dollar out of your rents and self-storage right now. Not to mention, you're probably not going to get you're probably not going to get agency debt on that deal right now because it won't qualify for agency debt based on where cap rates are at. So it's going to be really tough to be in self-storage today. It's the same case with multifamily. It's why multifamily is really hard to be in today. And then the thing with build to rent is you have holding costs, right? You're holding that land. You have development costs, and that's really risky right now. You have material costs, and so it takes a lot of cash. It's expensive. There's your rates are all over the place, and so you're just holding on to a lot of risk right now in this market. And so I like a business model that honestly is that that you're flexible right now, that you're nimble, that doesn't require a lot of equity, and ultimately isn't using debt. I mean, I like debt. Trust me, I've used a lot of debt in my lifetime, but I'm also getting burned by some debt right now. And I know a lot of other people are going to get burned by debt. And people who are jumping in right now, there's really no good answer of what that's going to look like over the next 12 to 24 months. Yeah, there's rumors that the Fed might lower interest rates, but who the heck knows, right? Like, who knows? So I preface all that to say I am prepared, by the way, tonight, and it's why we're focused in 2024 on land entitlement. So we have a business model, very simply, where we go out and contract raw land. So our business model right now is we actually don't go and acquire the properties. We contract them. This is a contract. We have earnest money in the deal, and the only money we're risking is earnest money and entitlement money. So once we contract the property, we take it through a due diligence period. If we determine that we can entitle this land, we will spend the money to entitle the land, and we're entitling it for subdivisions. So we're kind of the front part of what Bethany's doing. But the nice thing about what we're doing is we're not buying the land. All we do is we entitle it, and then we double close with a public home builder. So think of Lennar or D.R. Horton, some of your biggest public home builders in the nation. So what this allows us to do is be really flexible and really nimble in the market today. And we make all of our money in the entitlement process. And these public home builders right now, if there's anyone in the market who has equity or who has cash to spend, it's the public home builders, right? And so we're not relying on retail or anybody like that. So this is the model we're focused on in 2024, is going to be land entitlement. And we're doing it in a really interesting way that I haven't seen done. I did not come up with this. I'm partnering with someone on this. And so this is where me and my investors are going to be focused at in 2024.
All right. We had some shots fired there. All three of you, I think. I love it. All right. What type of investor do you think would be best suited to your particular asset class? Like, what kind of investors are you looking for? What kind of investors should be looking for your types of deals? Bethany, let's start with you this time.
Yeah. So the nice part about Ellis is he always gives me so much fuel. This is just amazing. So the best part about the investor is every investor is different, right? And what we've all been taught through our entire life is diversify, 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 right? You don't put all your eggs in one basket. You put them into multiple different baskets and things like this. So for instance, on build to rent, you actually have multiple baskets because those investors that choose to come in early and take the risk with us on the land and entitlement process are highly incentivized in our model, so that then if folks choose to come in later on the vertical or the horizontal build out, they're not making as good of return because they didn't take as much of the risk with us. So the investors that are coming in early are accepting that higher risk, but they're also getting a much better payout for that, right? And then those ones coming later on are looking for a more stable, this has already been funded, we've got agency debt, we've got all this in place, this is, fairly risk averse. Ability through not only the different phases, but also the different products. And so if you're looking for legacy growth and you're looking to build your wealth that way, it's not going to be a build to rent is not going to be your cash flow product at all, right? It's not an ATM fund. It's not you're building it out and then you'll start to see cash flow. And that's going to take a little bit longer than, say, a value add multifamily, which is actually about the same timeline as far as that goes. So if it's somebody who's looking for cash flow, build to rent isn't necessarily that, but we also have our debt side of it. And our debt side, we do have cash flow. So that we have that flexibility, and you can, so as far as investors go, anybody who's accredited investors that are willing to actually work with an experienced team, those are the types of investors that work well in our scenarios, just because of our background and probably I would just say mitigated risk that we've already stepped up alongside. So Ellis's company, he'll wholesale to us basically if we wanted to do anything in Arizona.
Ellis?
So yeah, we also work with accredited investors. Minimum investment being, typically about $100,000 or more. And really, our ideal investor for a model like this, in my opinion, is someone who really wants to keep American land in American hands, who wants to add dirt to their portfolio. And so typically, I love working with folks who kind of have a shared vision and faith and values and love for country, because I do think what we're doing is pretty important in terms of, and I mean, you can't build homes for the middle class of America unless you entitle it. And so I also think we're solving a big issue that America's facing right now, which is affordable homes. I mean, we have a massive, multi-million shortage in terms of units. We actually have more housing formations in terms of people forming households than we actually have houses being built in America today. And so, again, like a lot of our investors are high net worth, high income earning professionals who really do care about country. That's the value side, but the return side is we in the land entitlement space, there's really no depreciation benefits on what we're doing unless you're investing in a self-directed. But we do pay an industry leading 20% preferred return to our investor base plus upside. And so it's a shorter transaction cycle, about 2 to 3 years. And we do this in a fund model. So we're not relying on just one piece. We typically, like right now, we have about a $15 million fund open, and about 15 to 16 projects will go into that one fund. And so it's about a 2 to 3 year cycle. We pay a 20% preferred return, and then we do an 85-15 split, meaning once you hit 20% and return of capital, then our company keeps 85%, and then we give 15% on the back end. So it's a blended return of anywhere from 25 to 35 on the upside is typically what we're doing right now.
It's fascinating.
Anybody, Bethany, are you guys paying a 20% preferred return, by the way?
Yeah. Did I not say
Yeah,
we
right.
were highly incentivized on the front end doing what you're doing? Yes, we are.
What's your pref?
It's a 20% flat. It's not a, oh, we'll wait and see. It's a flat. You could be in that for 2 months and you're getting the 20%. You could be in it for a year and you're getting the 20%. So it's a pretty hefty incentive.
That's a debt fund that you guys are working. That's a 20%
Nope.
debt fund.
No, those are for the ones that come in during our land entitlement process, just like yours.
Nice.
But storage investors are totally different, Ethan. Correct me if I'm wrong.
Well, I think the majority of them would be, but yeah, the only investor I've ever taken on is just one buddy of mine who fronts the money for the deals that we do find, which like I mentioned, we only have 5 deals. But the cool thing about it is, like what Ellis mentioned, they're off-market deals. That's what we focus on, mom and pop places, so heavy value add. So I can afford, and a lot of times creative financing. So I can afford to get into these things, just with, him fronting the money and me paying him back. And he takes a very small percentage of the property. It's a great deal for me and my family. So that's all we've ever needed. And so, yeah, as far as like, investor capital, we don't need much, don't take much, unless we were to really scale this thing up bigger. And at this point, I just haven't done that.
Yeah, pretty much Ethan said, I don't need your money right now, is what he's saying. So.
Okay. No investment
Hey,
deals. Sorry.
Somebody in the chat asked a good question about the 20% prep, because I get this a lot, actually. How would you react? And some people say that's too good to be true. And the reality is, it is very different. But you also should ask yourself the question, like, what are we doing differently that the rest of, like, if we're able to be so profitable and pay 20%, what's so different about our model than everyone else's? And it's a good question. I do think you do need to be careful, because this is private placements, and, it's kind of the Wild West out here. So you shouldn't invest in what you don't understand. But just so we're clear, like in a multifamily deal where we're paying a 7 pref, the benefit you get in a multifamily deal where we're doing leverage is you get a massive depreciation benefit. And most people don't factor that into their overall return, right? So if you have a 7% pref and then you're getting a massive depreciation benefit, you really, if you calculated that in, that's probably more like a 12 to 14% preferred return when you take in depreciation benefits. In a land entitlement space, there's no depreciation benefits. We're not leveraging. We don't need the money to go close the deal because we're contracted the deal, and then we have no debt. And so, really, we're just front loading the return, is what we're doing, and there's no depreciation. So, really, it's a front loaded return from the land entitlement because we make all of our money when we sell to the developer. So, it is a different model. It's not too good to be true because I've looked into this a lot, and but again, to our point earlier is you're not going to be 100% allocated to land entitlements, right? You're going to have some. If you want to be in real estate, you should be in multifamily or you should be in self storage because you do want to take advantage of depreciation benefits in multifamily, right? We gave our investors on a deal we did last year 80% loss in year one on their principal. So that's pretty significant, right? So you could take the loss of this one deal and write off the entire distribution amount from this entitlement thing. So like you got to think about it from that perspective as well.
Well, and isn't this the last month of 80% and then it's going down to 60 next year for depreciation?
Yeah,
For the bonus depreciation.
80%. Yeah. In terms of total allocation, yes. Yep.
So we're losing opportunities. The longer we wait to invest, the more opportunity we're losing for depreciation to take advantage.
Right. But Biden's probably going to get impeached, and Trump will come back in and probably bring it all back, and we'll just reset the clock.
Okay, then.
I'm not a really political person. I'd be honest with you. I just said that because to be facetious, but yes, that's true. But I do imagine if we get a Republican back in office, that might be something that comes back. Who knows?
Maybe.
Yeah. Fair to certain, considering they were the ones that put it in place, right? So they're not happy that it got taken out. Most of those things usually come about from politicians who want to benefit from it.
That is definitely true. All right. So new question. Inflation rates have kind of been going wonky lately with the Fed raising rates.
By the way, I moved out of California, so I can say all kind of wild stuff now and not be faulted for it. I'm actually in a Republican state. So I don't got to deal with all this California, watch what you say, cancel culture anymore, right? I'm just shooting from the hip. So if I want to talk about Trump or Biden or whoever, I feel like I got a lot more liberty these days.
Well, so I'm pretty sure you said whatever you wanted to say in California too. I don't think that stopped you at all.
True. That's true.
All right. So inflation rates have been going up, and then the Fed decided to hold rates, and they are still holding as of right now. So how is that affecting your particular asset class, and what can an investor do to protect their portfolio in these high inflation times? Anybody want to start?
I can take that one. So I think one of the things to remember about everything, but specifically about investments and real estate, there's historical data on it. And if you follow the history and you follow the feds and you follow what they do, you can pretty much predict based on their history of what they've almost always done, what's going to happen. So did we get all freaked out when rates started going up? No, it was expected. It's a norm. If you've been through multiple cycles, you know this and you expect this. So as an investor, what an investor needs to do, again, is diversify. Because, for instance, if all of your investments were in multifamily and the particular maybe operator that you were working with had no new deals this year, because a lot of them didn't acquire as many deals due to the rate hikes. So you've got no new investments coming in. And just like we talked about the bonus depreciation, now you don't have as much offsetting. And maybe you had a big one sell this year, right? There was quite a few liquidations and such. So if those are some of the things you have to look at your portfolio of investments holistically to really determine what you would do as an individual investor with these rate hikes. I would definitely, by all means, diversify, but I would also not just diversify, I would be looking at it from the mindset that if the rates go up, I'm not going to have, and especially on multifamily or build to rent, it's a 5-year exit at that point. And in that scenario, this is the year you're going to be exiting. Okay, what am I going to do to offset these huge increases that I'm going to have? Because you're going to have a massive hit. So you should be looking at it from that perspective, not so much worry about the rate hikes, because honestly, the rate hikes, it basically reduced the number of people buying, not really much else as far as that goes. It reduced expendable cash for families. So rents and things were impacted, but people still have to live somewhere. So I think in that perspective, it's mostly focused on the diversify. Look at yours as a whole and recognize if I'm going to be exiting because of these rates. Like one of the questions that was in there, talking about they're looking to see a lot of distress in 2024 because the rates went up. They had adjustable rates. They were going to have to do, we're already seeing them. We're seeing what we call fire sales. People, they weren't ready to, they're not stabilized. And so they're not able to do anything but sell the property at this point. And so there's a lot of fire sales in that respect. And as an investor, if you're with the right operator, they're going to be able to take advantage of that kind of things. Recognizing too that sometimes it's not always about, if you're running your numbers right, it's not always about the debt rate up or down. It's about the long-term plan of it, because sometimes it's just a matter of waiting a year. And again, it's historical. So it's just looking at it and not freaking out and doing a knee-jerk reaction just because, oh no, they raised it this month. And then next month you're panicked because it didn't go anywhere, kind of thing.
That's a very good point. As an investor, you're supposed to have an even temperament, so don't panic whatever you do. Ethan or Ellis?
Yeah, it's that's really good. I think where a lot of times people or real estate investors will get into trouble is they will make too many assumptions or speculations. And like Bethany was saying, they're not really looking at what could happen historically. They're just focused on the upside and not necessarily protecting the downside. So I would say the best way to be less risky or mitigate that would be before you invest in a deal, before you purchase a deal, is looking at what your debt is and how you can protect the downside. So knowing for sure if rates do hit historical all-time highs, will that property be able to float the debt on it? Have you done calculate? Will it be able to do that? And if it won't, then maybe look at a different investment depending on what your risk tolerance is. That's my take on it. Is most of those headaches can be saved ahead of time before you get into the debt or before you sign or invest. Does that make sense?
Yeah, it does. Yeah, I mean, if you have fixed debt right now and is inflation as high as it is, you're probably feeling great about everything. Your rents have gone up, I mean, depending on what you're in. I mean, just, we've also seen values come down in multifamily right now because of that, because of where rates are. But again, like if you have fixed term debt, you want to see inflation go up. Why would you not? Your most expensive cost is fixed, and inflation means that, rents are getting higher, et cetera. So to that point, that's great. But yeah, I mean, your biggest risk on anything is going to be your debt. Like, a wise mentor told me, asked me the question one time, Ellis, where'd all the real estate go in 08 and 09? I'm like, what do you mean? I'm like, it didn't go anywhere. He's like, exactly. He's like, real estate doesn't go anywhere. People's equity disappeared. And that will be the same. It's same as true. It's happening right now in the multifamily space. And it's happening all over. And so, yeah, debt's a big piece. And that's why, to be honest with you, we're making this pivot into what we're doing now, because I want to be able to control the real estate transaction instead of be tied to it with the type of debt market we have right now. And so if we don't have to actually use debt, we're not necessarily tied in the deal because we're only under contract and we can renegotiate a contract. That gives us a lot of flexibility, and we take a lot of risk off the table in that matter. So, I mean, trust me, I've taken a lot of risk in the last couple of years, and some of that we've done really well, and some of that we're experiencing the heartburn for some of that right now too. So, it is all of what's been said tonight is true, and I'm learning that firsthand. That I'll be honest with you though, it's really hard to protect your downside, and your downside is interest rates going up 500 to 600 basis points. Like, that is, nobody predicted that. And so, yeah, there's going to be a lot of pain that everyone in multifamily, if you bought in the last 2 or 3 years you didn't put on fixed debt, is going to feel. And there will be money lost, if not completely, at least haircuts for sure. And who's to blame? A lot of people.
Yeah, to Bethany's point though, that makes it I forget who says it, but I'm gonna butcher this. But anyways, be fearful when everyone's greedy, and invest when everyone is fearful, if I said that right.
Yeah, totally. Yeah, I mean, I think 2024 could be a great opportunity if you have equity, or you can raise equity, or you're part of a group that can bring equity. 100%, there'd be some great projects, great opportunities with distress to get back into good markets and prices that you probably haven't seen since. I mean, I don't know, what are we in 2023? Probably 2018, 2019. I mean, you're gonna see a lot. We're talking Dallas, Texas right now, 6 caps. I mean, that's freaking crazy.
Mm-hmm.
That's true.
All right. So if you guys can put any questions you have in the Q&A, we're going to do a Q&A session in a little bit. But before we do, I have one last question for our panelists. And that is, what do you think that your asset class is going to do in 2024? Like, is this a good time to jump on board with your asset class, or should they hold off for a little bit?
Yeah, I can start. I look at our firm right now, why everyone's contracting, right? While everyone's trying to kind of become smaller in size and activity, we're actually growing. So we're hiring, we're bringing people on, we're raising money, we're doing deals. Because again, like, what our back end is just, where's the public home builder? What's the public home builder doing? Right? That's really the fuel of our business, is how much are they building? And right now we're kind of coming out of a slow, I don't know, whatever you call it, kind of a contraction for home builders. But things are actually really and Bethany can speak to this, things are really loosening up from, in the entitlement space. And so developers are wanting to build more, and it's getting easier to entitle land. So this is actually a great time for us in our business model. And, over the next 5 to 6 years, we hope to make a massive run in this space. So it's a great time for us, and we're really excited about what 2024 is going to look like.
Did you say you were doing a fund for multifamily?
So a fund for our land entitlement.
Ah, okay.
Yeah.
Got it.
Ethan, I'll let you go.
Yeah, I think it depends a lot on the market as far as self-storage, because I think I don't study the markets in detail, but I can just assume that, I pretty much say I know that in some markets they are oversupplying self-storage. It's kind of crazy. It's been a buzzword for the past 3 or 4 years in commercial real estate. Self-storage has been, and so some markets I think are oversupplied, and it's going to come down to how well are you operating it, how well are you positioned geographically, as far as how well is the asset class going to do. And that's all it can do when you're oversupplied. But the interesting thing about Americans is we always accumulate way more stuff than we actually need. We are the biggest economy for that. If you're going to develop a product, you're going to be selling to Americans. Even if you're developing a product that you're going to sell worldwide, America will be your biggest buyer by far. We just accumulate a massive amount of stuff that we don't need, and we get attached to it, and we never want to let it go. And when we do move to a new house or a place, we oftentimes need places to store it. So I would just say it would, as far as investing in self-storage, I would study the market to make sure it's not being oversupplied or has, a lot of money and dollars investments have gone into building self-storage facilities, because people prior to maybe this year and last year made some really good money building self-storage facilities and selling them to investors, because it was such a buzzword in commercial real estate. And here is something I wanted to say that's really important, because self-storage facilities, a lot of times people will say it's what do they say? It's recession proof or recession resilient, which is historically true. But why is that true? And I looked into this because I was very curious. And I think it's the reason why it's historically been recession proof or resilient is because it's never been tied up in a lot of REITs or big funds. It's a lot of it has been individuals, small people in towns who have a lot of equity in these properties and have had a lot of equity in these properties for many years. And so they've never been affected by, feds raising rates, because they had so much equity in it or they had fixed rate debt. And I think that's one of the reasons why it's been historically resilient. But that's changing. It caught the attention of big funds and REITs, and I would just caution you to think that, it's recession proof and it's never going to go anywhere. I think you got to be careful with making statements like that.
Ethan, that's a really good point. I always often wondered about that too. And being 100% remote like I am, I know exactly what you mean. I'm emotionally tied to my pictures and my kids' memorabilia, and I pay a storage fee every single month. I get it, but I've downsized it multiple times. So
That's good.
One of these days I will get it to where I won't. But in the meantime, it's worth it in my mind to pay the storage guy and keep them happy and keep that, and know I can always go back there. But so in regards to build to rent, we're not going anywhere, and we're doubling down. We launched in 2020. So we really already launched knowing the world's going crazy. And we predicted a lot of that. And because of our teams being so experienced, we handled it accordingly and put things like rate caps and things in place when no one else was doing it. Did we like having to pay for those? No. But again, experience, right? We recognize that and the value of that. So what happened in 2020 was they only allowed basically the new construction that came through was custom homes. Nothing else really got through. Office and custom homes were the predominant things that got through in 2020. And so because of that, the workforce housing specifically market got even more the cavern is wide now. They already had a housing shortage all across this country, specifically for that workforce housing area. It just got exponentially larger. So the feds have come out and stated over and over and over and over again, we need more builders. We need more workforce housing. We need it. They're incentivizing markets all across the country. So it's not a time for us to take it easy. It's a time for us to jump in. We're diving off the deep end and taking down a bunch of markets all at the same time because it makes sense. Are we still doing it smart? Yes. Going after some equity plays versus debt and better streamlined ways to do that, but also making it in a way that we can mitigate those risks so that, again, speaking of experience, when things happen, that the nice part about it is when you're building very large subdivisions, the city, especially when it's meeting a need that they already have, they tend to push things through when other things don't get pushed through. So a lot of the politics and things kind of go out of it. And it's a whole different scenario for us. So for us, we actually have cities that are really actively seeking us out and working to get us to come into their cities because they've got to meet the need. There's the state governments are coming down on them. You don't have enough housing. You need to build more. And they've got to reach out to builders like us that are doing it in multiple markets to be able to get it done. So we're going big. We ain't going home. We're going big, looking to build the machine even bigger and build it so we can do it in multiple markets, far greater than we already are.
Okay, let's go into some Q&A. This one's for Ellis. This one's for Ethan. In multifamily, we have a rent roll. Does self-storage also have a rent roll in T12 or other financials we need to learn?
Yeah, it's just a lot simpler, but yes, for sure. Yeah.
Right. Oh, I spoke to some lenders today and they mentioned rates came down today. I did not know that. And also distress is expected in 2024 as many will be motivated sellers as they have to refinance. What would you recommend in multifamily? Are we going to see sellers market if rates went down drastically due to the election as well? Ellis, you want to take that one?
Yeah, I'm trying to understand this question. I read this earlier. I don't think I understand, to be honest with you. Will be motivated sellers. What would you recommend in multifamily? Yeah, I mean, I would look for opportunities. There absolutely be distress. There's absolutely deals trying to sell. But a couple things with distressed assets is they're distressed because they're not selling. Like, you're not going to see a 95% occupied deal most likely selling. So they can't pay their debt because interest rates are freaking skyrocketed, but it's also because they were probably hard to operate or they're not getting the rents they thought they could get. So, you're not just going to be able to just scoop up great assets that are already performing at a discount. Like, you need to be with good operators. So people who are probably know the market, know how to operate, know how to drive revenue and leases, lease management, all that. So, or you're just going to get burned again, right? Because you're taking over a distressed deal that needs a lot of work. So that's what I'm seeing. And I think there'll be some great opportunities for people who know how to do all of that.
Okay, Bethany, this one is for you. Are you adding fire sales as one of your strategies in this current climate?
Actually, yes and no. The reason the answer is no is because just like Ellis said, if they're already in trouble, there's going to have to be a significant discount that they're selling at to make the numbers work for me to come in and basically save the day. In the same token, a lot of times, I just put this out there today. One of the best known strategies that we've done for years is property managers. A property manager is going to know when things are in trouble, what's going on and what's happening and things of that nature. And so oftentimes what will happen is because we have been so connected in the industry and so many of the players, it really is a small world. A lot of this one was partnered with this one and they broke off and now they've partnered in this one and this one. So a lot of those connections, when you hear of things like that happening, you're able to come alongside them. And sometimes they don't necessarily have to sell the entire property. They just have to sell a certain amount of shares or interest in it. And so there's ways that things can be done creatively that can still create a win-win. So we won't be necessarily looking like, I'm not going after, the 3,000 units or whatever that just came up in Houston and all that, because the amount that he would have to actually sell those for to make the numbers actually work is absurd. So a lot of times we'll just wait because the bank will have to foreclose on it. And when they foreclose, then now you can actually start talking to a bank and do a short sale and do some other things. And those things take time. So it's the moment it hits the broker's table. Am I looking at those? Nope. It'll be time.
Let's see. Also, there've been a lot of delivery in the last 2 years in the Sunbelt states, and vacancy is slightly high right now. What is your opinion on the future of built rent? I think you already answered that, Bethany.
Well, and what, Amon, I see your question, and it's a great question, actually. A lot of things, a lot of times when you're reading numbers and stats, it's oftentimes referring to the major metro, for instance, like downtown Dallas. It's not necessarily referring to the path of progress out in Greenville or past Denton out in Corinth or any of those. And so the information that you're getting is from a market. When we're doing build to rent, we're not in that urban market. We're in that path of progress because it's going to take us those 2 years to get that project entitled, built, and whatnot. So we're where everybody is wanting to go, and we're putting that product out in a market that there's not only the need, but they can handle the supply. We're not oversaturating a market.
Let's see. What debt would you use today, variable or fixed, and why? And if you choose fixed, if rates are expected to come down by next year, isn't it better to take the variable rate? Any of you can answer this one.
Yeah, could be. Just again, I mean, yeah, I don't expect rates to, I don't think anyone expects rates to continue to go up, probably go down. So he makes a good point. If you do agency debt or fixed debt, then yeah, there's a pretty big prepayment penalty. That's why a lot of folks had gone to bridge and then you couldn't actually get agency. So, but again, like you just need to be sure of your value, right? That you can, the reason you would use bridge is you're using bridge to move into longer term stabilized debt, or you want to sell it in the next 2 to 3 years. So it just depends on your business plan. And that the thing with bridge and what a lot of people aren't doing right now is, if you buy you get a bridge debt 12 months from now, you're going to have a DSCR requirement. So you still have to hit requirements in your loan agreement based on the revenue of your property. And so it just comes down to, is there enough meat on the bone to drive revenue? So it's too nuanced of a question to say bridge or agency without knowing the business plan.
Ethan, you have anything to add to that?
I was talking to a banker the other day, and Bethany or Ellis would know more about this, but I hate speculation. And so if I can get something locked in and I know it's going to work, then I'm going to do that. But if I can have the option of also floating down, then I'm going to take that option. And a banker I was talking to the other day, they have options available for us to do that, where we can fix something right now, even though it's high, but we can also float down. And that's something that I would do.
Mm-hmm.
Yeah, and Ethan's model is very different. Like he's buying to hold. He's buying to cash flow for him and his family. That's a lot different than buying an asset to try and get a return for an investor in 5 years. And so that's a very different model.
Mm-hmm.
Bethany, does build to rent look any different between fixed and variable debt in terms of, because it's more of a long-term deal?
Actually, yeah, because we're doing it in phases. So honestly, some of the institutions and things that we've been doing can't go big enough for what we're doing. So we might use a smaller credit union for the first phase, and then we might step up. We actually have a couple credit unions actually coming together and to create a fund to supply us for the next part of it. And then other times we might be using a national lender. But each time we're looking at it with a different strategy, right? So if we're just doing the entitlement phase, or we're just doing the vertical build out, we know that that's a very set amount of time, even if we plan in delay after delay after delay. And so it doesn't necessarily make sense to do a 30-year on something like that when you're going to have to pay those refinance costs and all that anyway. But if it's a situation where we've got a lender that can go the full with us, and then we just do it in stages, then it's worth looking at from that perspective. In our case, it's just mostly because we have different timelines on there. It's not just like one thing that you're doing.
Okay. I think we're down to the last question. What do you think, how would you increase the NOI in 2024 as rents are also kind of stagnant right now?
Well, I think the interesting thing about that is rents in different markets are stagnant. In some of my markets, our rents are still going up. In other markets, they've gone down, and in other markets, they've stayed flat. So a lot of it just depends on the individual market. You see the biggest ups and highs and lows on the coasts, East and West Coast. Midwest area, you see more small dips like this. So increasing NOI for us isn't always about raising rents. In fact, a lot of times it's not about raising rents. It's about being more efficient in how we're running our operations. It's decreasing our expenses. Is there additional revenue that can be brought in, whether it's pet fees or laundries or rubs or different things? It's looking at it from a holistic approach, not just we're just going to raise rents. That's not always a business model we even subscribe to a lot of times.
Ethan or Ellis?
That's true. All right, Bethany, that's great. I love that. She's right. And I think a lot of times this is one of my principles of finance and wealth is there's always low-hanging fruit that other people don't see, and there's a lot of meat that's always left on the bone that other people may not. And so that's one thing that I like doing as a good operator is finding what that is, getting creative with that property and how we can increase revenue or decrease expenses. If we have a property and you can't build any more units on it because of code or something, then place the mobile containers on it, right? Or because of setbacks, we ran into that, so we placed the mobile containers on there. You can lease locks. You can instead of selling them to the customer, or instead of like charging for deposits, you can do the admin fee, and so you don't have to give those deposits back. You don't have to keep track of them. It's added revenue. So there's all different things besides just increasing rents. So I think a lot of times people just stick with the norm and don't get creative and scrappy with how they can increase revenue to increase NOI or decrease expenses. I heard someone say this once. It's like expenses are like fingernails, always need trimming. I was like, oh, that's really good. I'm like, that's so true. And so chop all of your expenses because they just go up, and you can find ways to get them down.
I don't have anything to add. I mean, it's not our business model in 2024 is not to raise rent. So I think what they said was great.
Okay. Can we just go around and can you tell my guests how to get a hold of you or any deals you have in the works right now? I know I'm in contact with an oil and gas fund, a build to rent, and an ATM fund as well. So if you're interested in those deals, you can reach out to me. I'm on Instagram, Facebook, and LinkedIn. And Bethany, how can they get a hold of you?
The best way to reach out to us is definitely through LinkedIn, but also I have a YouTube channel, and on our YouTube channel, American Made Home Solutions, or you can search my name, Bethany Finch. There's tons of free content on there. So go there, learn. We've got all kinds of everything on there from executive rentals to multifamily, but it's an opportunity for you guys to kind of dive in and get a few more of those questions answered so that when you come back to Carrie, to look at some of the investment opportunities that she has, it gives you the opportunity to ask better questions. So otherwise, in our end, they can always just reach out to us on LinkedIn. It's usually the best bet, or find our company, AmericanMadeHomeSolutions.com.
Ethan?
Oh, shoot. Email. I'm happy to do. Can you get an email?
Can you put your email in the chat, please, for our guests? Just so we can see
for sure
what it is.
Yep.
Ethan's always willing to reach out over email.
Do anything else, I'm not good, but we'll get the email.
Okay. Got it. Thank you. And I know, Ellis, you just put something in the chat as well.
Yeah, I don't think they can see it. Allied Dev, ALLIED dev.com/investors, or email me, ellis@allieddev.com, and I would love to connect.
So I don't think we quite settled the question of what the best asset class is. I think all of you think you're right. But I have a question for Ellis. Ellis, you just moved, right? Did you happen to put anything in self-storage?
I put everything in a pod actually. So does that count?
Yes, it does.
Storage, right? He's storing stuff that he doesn't need.
Yeah.
Pod, right?
Yeah, moving pod. Yeah, no, I think the pod businesses, I mean, those guys have a market right there. It's amazing.
Yeah.
Well,
Yeah.
thank you.
And you'll pay whatever it costs. I mean, there ain't no way to get your stuff anywhere else. So they got a great thing going.
Smart little cookies.
Well, thank you all for joining me, and I hope you have a wonderful evening. Thank you.
Thank you, Carrie. Awesome job.
Yeah, Carrie, it's been great.
Thank you. Bye-bye.
Thanks,
See you guys
Carrie.
soon.
Thanks, Ellis. Thanks, Ethan.
Bethany, awesome.
Thanks,
Great
guys.
entrepreneurs. Love you guys. Bye.